Hello, good afternoon. Welcome to our panel of transitioning from centralized finance to decentralized finance, the inside story. Today, we have some excellent panelists. We are going to be speaking with Uri Klarman, CEO of bloXroute Labs, Varun Verdula, founder and CEO of Hashflow, and Hasib Qureshi, managing partner, Dragonfly Capital. I'm your host for this panel, Christy Harkin. I'm the managing editor of technology at CoinDesk. And so today, transitioning from centralized finance to decentralized finance, the inside story between 2019 and 2021, DeFi volume grew from $100 million per year to $1 trillion per year. What are the origins of this growth? How do the properties of decentralized vary from traditional finance? And what changes should you be thinking of and taking into consideration in order to adapt to this new world? We're going to start today's seminar with Dr. Uri Klarman, CEO of bloXroute Labs, and he will address the unique characteristics of DeFi and forecast what's next. We'll start with him, and then we will be speaking with our other guests in a panel. And following that, we should be able to accept some questions from the rest of you who are watching, and thanks for joining us. So I guess we'll start with the presentation part from Uri.
Hi everyone, Uri from bloXroute here. Let me just make sure everything is working properly. There we are. Share screen. Sorry about that, guys. Something went terribly bad. Okay, sorry about that. That was longer than anticipated, but we're here now. Hi, everyone. I'm Uri, CEO and co-founder of bloXroute Lab. We're called bloXroute because we route blocks and transactions. And today we'll talk a bit, as Christy mentioned, about this transition from CeFi to DeFi and what does it actually mean? So we've been hearing about DeFi and maybe you're already deep into DeFi, but some properties of DeFi we're just figuring out. I have a PhD in computer science, more specifically computer networks, and even more specifically, the blockchain network layer. So bloXroute is kind of like the crown jewel of my PhD dissertation. I found it with my then advisor, now co-founder, Professor Kuzmanovic. And the TLDR of what we do is routing blocks and transactions. And we'll talk about why that matter today. So let's start with DeFi and the transition into it. Everybody are talking about DeFi. DeFi, as Christy mentioned, is getting very, very big, right? DeFi volume was $100 million in 2019, and it reached a volume of $1 trillion per year in 2021. But what does DeFi really mean, right? When we move and we take these traditional finance and centralized finance, like let's take exchanges and let's take like lending and borrowing and asset management and all of that, and we move that on-chain into DeFi. What does that actually mean? And some properties of this are maybe obvious to you, some of them are less obvious, and some of them, as I mentioned earlier, we're really just wrapping our heads around. So the easier ones are maybe that when we take like matching engines and back office, and instead of using them on an exchange, on a stock exchange or something like that, we have smart contracts on chain. Well, if you're into DeFi, that's nothing new to you. Even if you're not in DeFi, you probably heard about smart contracts, right? These are just, instead of you working with the exchange, you interact with the blockchain. There is a smart contract, there is a program running on chain, and you can interact with it. Some other properties are, well, instead of having like order flows and price feeds, which we're very familiar with from traditional finance and centralized finance, all of a sudden you have transactions propagating around in a peer-to-peer network and the blocks propagating around. And again, we'll talk deeply more about that, but that's not super confusing or super complex. Okay, slightly different. You have these propagating, but kind of same thing. But one property of DeFi, which is very, very different, and I want to pay close attention to it today, is that DeFi changed the model that we're talking about. Instead of being point-to-point, we move to peer-to-peer. Right now, if you're a competitive actor on the traditional finance, then you need to be connected with Chicago, New York, London, Japan, Hong Kong, something like that, right? And that's enough. You need to co-locate, you need to be fast to interact with them, to hear from them, but that's that. But in DeFi, all of a sudden, you need to be connected to the entire network, actually multiple networks, because critical information, and I'm intentionally vague when I say information, can come from anywhere, right? There could be a transaction selling, let's say, 10,000 ETH on Uniswap. Uniswap is the largest decentralized exchange out there. That transaction is coming from Australia. If you're a market maker, if you're a big trader, if you're anything substantial in DeFi, you want to see this transaction as soon as it's being created, right? That's going to change prices. You're going to need to adjust your positions, not even in DeFi. Maybe you're a market maker on Coinbase or on Binance, but seeing that information ASAP is critical for you because it's going to change everything. Same for oracles, right? An oracle transaction saying, well, the price of ETH is now $2,900. You need to see that. That's going to affect everything in what you're doing. You have this internal price. What do you think the price of ETH is right now? And all this like data streams that you need to listen to are going to affect that and your position in the market. If a new block comes out on Ethereum, on, I don't know, BSC, on Polygon, etc., it's going to have new prices, new information, new state, and you need to see that ASAP. And there's no longer a way for you to co-locate, right? It's not like the CME, right? It's not like Chicago and New York and London, etc., that you can just connect to them. You're not connected to everybody else. You're going to hear about it from the peer-to-peer network, but it might take you quite a long time. And during this time, you're out of sync. That's not a very competitive position to be in when you're not exactly sure what's happening in the market. This is kind of like leads into what we're doing. bloXroute is Flash Boys for DeFi. Okay, you can think of us as like your optic fiber cable connecting you with everybody else. We have a global network of servers that what we do is propagate transactions and propagate blocks extremely fast. Our average is like under 150 milliseconds, which basically means we're not at the speed of light, but we're not far off from the speed of light either. And so what we're doing for our customers mainly is to propagate transaction and blocks so they can be competitive in this DeFi market. We're routing $1.5 billion of trades each day. And what we're going to talk about in this presentation is about speed, front running, and congestion in the network layer underneath blockchains. Why do you care about it? Like if you're just getting into DeFi or you're already in DeFi, why should you care about speed? Why speed matters? Like, of course, speed matters like in high principle, but actually, if you want to quantify it, how much does it matter? What does front running mean? What happens to your transactions when you participate in DeFi? How does congestion affect it? But before diving deeper into that, let's take a short break and make sure we're all on the same page, how blockchains work, how transactions work, how DeFi works. And maybe you think that DeFi is complicated. Maybe you think blockchains is complicated because a lot of the time people explaining it make it sound complicated, but this should be very, very simple. If you don't know anything about DeFi or blockchains, this should be like very easy for you to understand. The way blockchains and DeFi works is that if you want to make a transaction, right? If you want to send somebody money or make a trade or mint an NFT or any interaction whatsoever, you create a transaction. A transaction is just like a number of bytes, but you kind of like you sign them and just send it out to the world. So you want to make a trade, it's an order, do this and just send it out there. And you're connected to some of the network, which is connected to the rest of the network. And so this transactions kind of like propagate all around the world. Everybody can see them. And so if I'm making transaction and Varun is making transaction and Hasib is making transaction, all these transactions coming from everywhere and propagate in the network. In the network, there are special entities called miners. Sometimes in some protocol, it's called validators, but it's one and the same. There's like, no, for this purpose, there's no distinction. And so miners listen to all these transactions coming from everywhere, and they try to aggregate them into blocks. So blocks are just like headers, a timestamp, a version, etc. And then a long list of transactions which are to be added to the blockchain. And if you heard about mining or staking in the past, that basically means whoever creates a new block gets money for it. So the reason miners are out there trying to create new blocks is because they make money this way. And so transactions propagate around, miners compete with one another. Who would be the first to create a new block of transaction? And then one of them is lucky enough or successful enough to build a new block. That block also propagates to everybody else. And the miners start competing on creating the next block. And this is somewhat of a weird process. But the result of it is that people make transactions and blocks containing them are being added to the blockchain. And the result, this chain of blocks is the blockchain that everybody keeps talking about. And if I made a transaction trying to sell, I don't know, buy Bitcoin, buy Ethereum, or sell them, etc., or I mint an NFT, that transaction executes when it's added to the blockchain. Okay, so when it's added to a block, that block added to the blockchain, then this is when the transaction actually happened. And I'm hoping this was simple and clear enough for everybody, because we're going to revert, going back to that and understand what are the implications of moving from, the CeFi, which we're all familiar with, into that model. And so I said we'll talk about three things: speed, front running, and congestion. Let's start with speed. Okay. Let's say that you're a DeFi trader or a DeFi actor of some sort. That means that usually you're looking for opportunities, maybe arbitrage opportunities, maybe making trades, liquidations of loans, etc. Usually it means that you're waiting to see a transaction or a block which has some importance for you. Maybe prices drop, maybe prices increase, something like that. And then you create a transaction and you're trying to get to the next block, as we just described just a second ago. Here's the thing. If you're participating in DeFi and you see a new block, it usually means that block was mined something like over half a second ago. So when you actually get it, it's actually been quite a long time since that was actually created. So if it takes you just over half a second to get the block, and you identify an opportunity, and so you create your transaction, shoot it out there in order to maybe make a good trade or something like that, and your transaction takes, again, somewhere between half a second and a second to actually reach the miners and have any chance to be added to the block. That means that during this time, in 10% of the cases, a new block would be mined before your transaction has any chance to get into it. Okay, maybe by the time you got the block and it says, oh, the price of ETH dropped to $2,900, and you want maybe to buy ETH, okay, ETH or BTC or whatever, any asset on chain. In 4% of the cases, a new block was mined, prices have changed, the state of change before you even saw that block. And by the time your transaction gets there, it's 10% of the cases, you're too slow to actually capture opportunities. In 10% of the cases, by the time you saw it and your transaction actually got to the miners, in 10% of the cases, the next block was already mined and you missed the boat. You missed that opportunity. If you want an easy analogy for this is like playing an online shooter with really bad latency. Okay, you might be playing a game and you're seeing oh, here's somebody, I'm going to shoot him. In reality, you have a really bad latency. Somebody already came here, he shot you, he moved on, you're dead. You just don't know it. You'll figure it out in a second. And so speed matters greatly in DeFi. In CeFi, it does as well, but in a slightly different manner. Everybody when you're coming from traditional finance, you're very much aware that you need to be fast for algo trading, et cetera, et cetera. In DeFi, it isn't that clear. Why do you care about seeing fast and sending fast? Because during this time, that will define how many of the opportunities you have access to. And what we do at bloXroute, we cut that propagation between half a second and a second and a half. That means we're giving you something like between 7 and 40% more opportunities to capture. Okay, these are opportunities which are right now closed to you. a few words about what is it that we actually do in our tech. We have a network of servers all around the world which propagate transaction and blocks really fast. As I mentioned, 150 millisecond or so. The reason that we're fast is A, our servers are fast, that's easy. And B, good topology, okay? So we just connect them directly and make sure we don't use congested lines and private link into China and these kind of networking stuff that we're doing. But there are a few things that we're doing which are more interesting than that and you might care about. One of them is that when you send a transaction into the blockchain, you're going to send it to your peers, right? Those that you are connected to, and from them to their peers, and from them to their peers, hoping this would actually go to all the miners in the network. What we do is broadcast. Okay, you give it to us and we basically send it to everybody really, really fast. And we're also directly connected to miners and very big traders and projects. So by being very, very well connected already, like 1,000 different nodes are connected to us at any given time, then that means when you're sending us a transaction, it actually reaches everybody else basically immediately. So that's on speed. Another thing that I want to talk about is front running. DeFi, again, is different from CeFi, okay, from centralized finance or traditional finance. Because when you send your transaction out there and it propagates in the network, it means everybody out there are seeing your trade before it executes. Okay, that means that it's not like, you send a transaction to a stock exchange or a centralized exchange, and that just like, okay, takes place. Maybe if it's an order book, somebody might see it because it wasn't immediately taken, but nobody can see it before it actually is, deployed or executed. Not the same in DeFi. Okay, you send a transaction, and before the next block is mined, that transaction is there for everybody to see. And that is very, very significant. There's an entire ecosystem out there, which is called MEV. I won't go down that rabbit hole, it's slightly too deep. But basically an entire ecosystem of people saying, well, if I see somebody going to buy $1 million worth of Bitcoins, I'm going to sandwich it. I'm going to front run. I'm going to buy it before he buys it because that's going to increase the price. I'm going to buy before he buys it. And then immediately after he executes, I'm going to sell. So I benefit from the fact that he increased the price. So this is front running and back running together. It's called like sandwiching. And this is something significant. Okay, we're seeing from our customers that they reach out to us and they say, Uri, all the speed and everything is really cool and very interesting. Not very relevant for us. We're not high frequency traders. We make one transaction a day. We don't care that much. But every time we touch DeFi, we get front run. Every time we try to make a transaction, somebody sandwich us. They get in front of us, they get behind us, capturing value in both directions. What do we do? And so what we do, a service that we're offering that we called it Fast Protect, is private transactions. Okay. Instead of just sending your transaction out there for everybody to see and to be able to front run and back run, you can give it to us. We don't broadcast it. We just give it directly to the miners, to the mining pools, to the validators out there, and they add it to the next block when that is being mined. They don't broadcast it either. So your transaction remains private. Nobody is taking advantage of you. Worth mentioning maybe that if you're making a trade, and again, if you're coming from CeFi, this is like old, like this, but if somebody fronts run you, he's capturing value and he's actually hurting you. He's buying, if I'm buying Bitcoin, he's buying Bitcoins before me, increasing the price. It means I'm getting a worse price. Back running is also capturing value, but it doesn't hurt me, right? If I bought Bitcoin and I increase the price on the exchange in which I bought it, well, maybe now that price is not aligned with the rest of the ecosystem. Maybe I can sell here and buy it elsewhere to kind of like until everything kind of like balances out. So front running really hurts you. Back running doesn't. It just like means you left money on the table. What we do, as I mentioned, is private transaction to avoid front running. And we actually started a cool service that we call Back Run Me, which means you route your transaction through us. If there is back running to be done, we'll actually do it. We have like people that's their expertise, like it's services that this is what they do. And if there's value there, the user gets half of the money back, so or 40% of the value back. Basically, if your operation is leaving money on the table, we'll help you clean that out You'll take half of it. The service that does it does half of it, and we take a small portion to ourselves. So that was speed. That was front running, which you should care about. This is something you should pay close attention to. And lastly, I want to talk about congestion. DeFi, as you all know, is very, very volatile, right? Like there are no circuit breakers in DeFi. If prices go down by 10%, there isn't like, well, let's stop and rethink it, okay? So that means that the prices in crypto, the prices in DeFi are very volatile. And the concept of like, panic selling and everything like around that you really want your transaction and get out of position really fast happens. It happens all the time. And it matters. Like this is whether you actually get out before everything crashes by 15% or don't, or if everything goes up by 20%. This means whether you made it before it happened or not. But if you recall, if we talked about that these transactions propagate in the network and then being added to blocks, in this situation, when the market is very volatile, then we're actually seeing that the network gets very, very congested. All of a sudden, the market is starting to crash. Everybody try to get out of position. Okay, everybody are trying to panic sell. Transactions are, filling the network. They don't get mined. They don't even get to the miners and the pools. There are just too many transactions out there. Even there are some malicious actors out there. If you want to get out of position, you send your transaction and you spam everybody else. You send transactions which slow down everybody else so they don't compete with you while you try to get out of position. And so this is something, again, if we're trying to think how DeFi is different than CeFi, yes, in CeFi exchanges will be congested and loaded, etc., but in a different way, not in a manner that the network itself is congested and your transaction doesn't go through. And so in order to try to help people with that, as I mentioned earlier, the reason we're fast is because we're directly connected to all the miners and all the validators. So if you're out transaction through us, you actually avoid the line. It's kind of like it's going to reach them directly. Maybe you'll have to pay high fee to get in the next block. Maybe you'll still have to be competitive, but you won't get stuck outside without being able to play. And so these are the three properties which I wanted to kind of like touch upon in this presentation, how DeFi is different from CeFi, about how speed matters, about front running and how everybody else can see your transactions when you're out there, and how congestion affects and like how you really need an execution infrastructure which allows you to execute even when things are very, very volatile. Lastly, what's the takeaway from this presentation? From my perspective, if you're not in DeFi yet, and we have some insight into who's the crowd here. So we know some of you are like, DeFi degens, everything I'm saying here, you already really know that really, really well. But some of you are new to DeFi. Some of you are considering getting into DeFi. So a few things worth mentioning if you're new to this space. First, it's not too late to be early. Okay, this is starting to become serious. As we mentioned, it moved from being a volume of 100 million, went up in 2 years by 10,000x into $1 trillion per year. Yes, it's bigger, but this is today. You want to learn today. You need to learn and figure out the know-hows and everything and make all the mistakes and build it up right now, not tomorrow, not when it's 10x or 100x or 1,000x from where we are today. So yes, now is probably the best time. If not yesterday, then today is the second best time to figure out your execution. How do you actually use DeFi for your setup? If you need to actually build this or persuade your bosses that this makes sense and this is valuable, etc. Like you probably want to figure out how to operate here, reach out to us. Okay, like this is what we do for a living. Either to hello@bloXroute.com or directly to me, Uri@bloXroute.com. Basically, just go to bloXroute.com, go to the website, you'll find 5 different ways to connect with us. If you're already in DeFi, then I hope this was also like, you maybe know DeFi, but the network underneath it is usually new for most people I speak with. I'll quote Satoshi Nakamoto here. If you don't believe me or don't get it, I don't have time to convince you, sorry. I don't actually mean it, but I always like to have like a good reference to Satoshi. But if you're already in DeFi, if this didn't make you like want to speak with me, then I'm probably doing it wrong. That's it from my end, and I think we can move to a panel and questions, etc.
Great. Thanks so much, Uri. That was really interesting, and I'm certainly looking forward to seeing where all this is going to lead. We have joining us a couple more people. So Varun, I think we can turn cameras on at this point. So Varun Verdula, who is the founder and CEO of Hashflow, and Hasib Qureshi, the managing partner of Dragonfly Capital. And I know that both of you are going to want to talk about Hashflow, which of course, we're going to have to bring all of this around to relate it to what Uri was talking about. But before we sort of branch into all of these other questions that are going to, I wanted to ask Uri a quick question about MEV and maximal extractable value. And I know that a lot of the problem before, just to make sure everyone understands this concept, and we're not going to get into the weeds, don't worry, I'm not going to make you backtrack into the weeds there. But I know that some of the major problems with MEV is the bots, that the whole landscape is populated by bots, and these are just sort of climbing all over all of the transactions in the mempools and trying to front run or sandwich and attack them that way. How will your program sort of stymie the bots?
So that's an excellent question. Let's say just like in 2 lines, like what is MEV, so people like have an understanding without getting too deep into it. Basically, when DeFi started to get serious, then people started to figure out, well, if I see a transaction, there's a big opportunity, I'll send a transaction and pay a really high fee. And then Varun comes in and say, well, I'll pay even higher. And then Hasib comes and say, well, and people had these kind of trying to compete with one another. And that drove prices and fees up really for everyone. And then came an organization, which I really like, and I'm very friendly with, called Flashbots, and said, maybe we can silo all this, like trying to beat one another to capture value. Maybe you can silo it from the regular users. So all these auctions don't have like negative externalities and affecting everybody and increasing fees for everybody. And so MEV, maximal extractable value, is a question, how much value can be extracted from there? And instead of people just increasing the prices, it became an auction of, I'll offer the miners $1,000 if they include these transactions. And Varun comes and said, I'll offer 1,001. And Hasib offers 1,000. Whoever offers them the most gets in. And so this, instead of this becomes a competition, who can extract the most value? If I'm better at identifying opportunities and faster on doing it and be very smart, effective in doing it, then that means I can capture more value. It means I can pay them more and I will capture more opportunities that way. And so MEV isn't negative by definition, okay? MEV is the reason prices across different exchanges are actually on the same level. It means that if one of them is off, somebody would see the opportunity, buy cheap, sell high until everything balances out. It's not a negative thing. The negative thing, or potentially negative thing, is when it's going to capture value from, let's call them innocent users, okay? I make a transaction, I just try to send something, and maybe I'm not sophisticated enough or good enough or understand the ecosystem well enough. So that means that when I'm sending my transaction, somebody else front running, sandwich it, right, et cetera. So like capture some of the value that transaction was aiming to make. And so going back to try and answer your question, how do we mitigate it? Some of it is just avoiding them completely. Like, give it to us, we give it directly to the pools. They never see it. You can't get front run and back run. You can't get sandwich if they don't see your transaction. That's some of it. Other of is maybe Varun might actually have a very good like answer to that. Varun built a product which like MEV bots can't extract value from. So like maybe at that point maybe I explained that at the higher level, but this is a great like Varun, feel free to take it from here because I think your take will be very interesting. Hold on, you're muted.
Just a moment, can you hear me? All right, excellent, cool. So thank you, Uri, for a very elaborate explanation for MEV. So I think, yeah, just a quick background. So I founded Hashflow, and it's a decentralized exchange. So if Uri is working at the layer 0, no pun intended, we are working at 2 layers above that. So we've got the blockchains, and then you have applications built on blockchain, and Hashflow is one of the decentralized exchanges that allows people to buy and sell cryptocurrencies, right? Now, like Yuri mentioned, one of the reasons why MEV happened is because of the traditional dexes that got built on Ethereum, which follow this idea of AMMs, or bonding curves. Basically, in a nutshell, what that means is you use some kind of a mathematical formula in the smart contract to determine or price the assets, right? So it's almost like a vending machine where user goes and requests a quote, and the smart contract uses some mathematical formula to determine the price and then give user that quote. Now, things get interesting when the person, in this case, your miners are the ones who are getting to put those transactions in the block. And the moment when you have the last look in terms of what transactions can go in the block and in what sequence, you can essentially use that information to reorg the transactions in such a way that actually benefits you, right? And this is because you have the visibility into the transactions, and you also control the sequence in which these transactions get included in the block. And because each transaction going into these blocks affects the price of an asset, because the pricing is done on chain, it becomes problematic, especially for large trades, which results in things like sandwich attacks and MEV that Uri just described. So what we ended up doing is we're like, why don't we unbundle Uniswap, right? So let's start with the model. The reason people like Uniswap is because of the vending machine experience, right? You know, people want to go trade in a trustless way. They want to go request a quote, get something, and go home, right? So why don't we preserve that? But the way price discovery is done, I don't think that most users necessarily care about the price, so long as the price they're getting is a good price. At that point, what they want is guarantees that the trade is going to go through and they're going to get what they see, right? So if that's the case, then what we decided to do is went ahead to our friends in CeFi world who actually perfect price discovery and have been spending hours of compute time and capital, particularly to do that, to issue us these quotes, price these assets, and then before the quotes go through, they cryptographically sign it already ahead of time. So as a result, even if your miner has information about the transaction, they can't really do much in terms of manipulating the quote or the price, because the quote is already signed by the person who has issued the quote. So all they can do is include the transaction, and no matter what sequence they send the transaction in, that doesn't really affect the price, because the pricing is no longer being done on chain, right? So you've basically moved the pricing logic off chain, and you have still kept the settlement and execution of transaction on chain, which obviously protects users against MEV exploits, sandwich attacks. It also improves price discovery, and also allows you to do a lot more in terms of pricing the assets. That is not just limited to spot or blue chips. Like, you can do a lot more interesting things. And it also becomes a new gateway for traditional firms who have been watching DeFi, have been wanting to participate in DeFi, and figuring out ways to go about doing this. So that's sort of a short summary of how things work, but happy to answer any more questions there. Thank you.
That's great. No, that's really helpful. Thank you. I wanted to make sure that Haseeb had a chance also to talk a bit about what Hashflow is, where it sits in the CeFi DeFi spectrum, and what its main purpose is in all of this.
Well, so I think, as Varun put it, Hashflow is intended to be, ostensibly a replacement for, or at least a replacement for, part of what decentralized exchanges like Uniswap do right now, which is basically be the place where you can find the lowest and best execution for trying to buy crypto assets on chain. Now, it's an interesting extension of a trend that's been going on for a very long time, right? When we talk about the distinction between CeFi and DeFi, back in 2017, the idea that DeFi means that everything happens on chain. That's what it means to be decentralized, right? Everything happens directly on chain. The original version of this was kind of the OG decentralized exchange, which was Ether Delta. Ether Delta was this order book based exchange. A lot of people, I'm sure, who entered in crypto in the last 3 years are probably not familiar with the story.
Haven't
So
heard
Ether
them in a
Delta,
while.
yeah, Ether Delta was an order book exchange. It was like like Coinbase or any other type of order book, where all the orders were on chain. And as a result, it was very slow and expensive because if everything is on chain, every single posting an order, removing an order, all of that costs money. It all costs gas. And of course, this was during 2017 when Ethereum gas prices spiked for the first time. And it didn't really work very well because there were trade collisions and all these things that just make it really suck, right? And that was the V1. And originally, that's what we expected that DeFi was going to be, was that everything lives on chain. And as DeFi has matured, we've started to realize, like, hey, this idea that you put everything on chain is not going to scale. In the long run, you have to find parts that are not central to the trust model that you can extract on chain and move them off chain, right? So that's why you look at something like DYDX, which has an off chain order book, but the settlement and execution happens on chain, is exactly the kind of phenomenon. We see it happening with rollups. Rollups are this idea that you take the state, move it off chain, but the guarantees around the correctness of the execution happen on chain, right? So that allows you to scale up smart contract execution even to happen more and more off chain instead of happening on chain. And so it's a broader phenomenon we're seeing. When people originally thought DeFi, they thought everything on chain. And more we're starting to understand how you can extract parts of the system that aren't central to the trust model, which is why we care about having things in the blockchain to begin with, is for the trustlessness. Is moving those things off chain in order to maximize the throughput, the scalability, for something like DeFi, the price execution. And I think that's increasingly direction you're going to see as DeFi and CeFi, centralized finance, continue to co-evolve. You're going to see more hybrid models like this. That's the direction that I think overwhelmingly crypto is going in. And it's also the direction that DeFi is going to go in as well.
And so to take a step back again, just to make sure that we're getting this parallel understanding of what Hashflow is doing in terms that newcomers to DeFi can understand. How is it different from AMMs?
So an AMM traditionally, so what an AMM is basically a formula at the end of the day. It's a formula that decides if I have this much of, let's say ETH and USDT. Okay, if I have this much ETH and this much USDT, I have to follow this exact formula to decide how to price it. That's what AMM is. Every single AMM is just a different curve and a different equation and a different set of rules. But they're all very, very simplistic. And the reason why they are very simplistic is because that allows them to be computed very efficiently on chain. And that's why AMMs ever existed, right? If we had super high throughput, super low cost, super low fee on-chain transactions from the beginning, then Ether Delta could have just worked. We would never have needed to go anything beyond the way that normal exchanges like NYSE or the NASDAQ end up working. But because we don't have that, we invented these sort of these more complicated, simplistic models that work well for executing large orders and complex orders on chain. That's what AMMs are. And Hashflow basically says, okay, look, guys, AMMs are cool. Obviously, they were a big step in getting a lot of on-chain execution working, but they have a ton of problems. And one of them is, their execution of prices is not great. If you look at Uniswap V2, Uniswap V2 charges 0.3%, 30 bips for every trade. That's like Coinbase fees, very high. It's very high fees. You go somewhere like Binance and you never pay more than 10 bips on Binance. Binance is like very, very low fees, right? Most places that you're buying crypto on is extremely low fees today. Except Coinbase, for whatever reason. That's a separate panel of why Coinbase fees are so high. But the thought should be like, well, look, the whole point of DeFi was that we got rid of intermediaries. We made all this stuff out in the open. Why are the fees so high? Shouldn't the fees be lower? And the answer of why the fees are so high is that basically Uniswap V2 is dumb. Uniswap V2 doesn't know what things should be priced at. And so it needs a margin of error so that it knows, look, I don't know how to price these things. I'm not a fancy market maker. I'm not I don't have these complex algorithms running. I just have this simple equation that I'm doing. And as a result, I need some margin so that I can make money even if I'm making a bad trade. That's why Uniswap has these wide price bands. That's why the fees are high. And so what Varun is doing here is he's saying, look, what if I take the pricing and I move that off chain and I let really smart market makers decide what the prices are, but the execution happens on chain. Now suddenly I can be super low margin. I don't have to charge 0.3% fees. I can charge super, super tiny fees, the same fees that a market maker in the normal world, right? If you go on, Binance or Coinbase, market makers are making bips. They're making, 0.001%, 0.002%, 0.003%. That's what they're willing to do to make a trade. And so if you could, again, disintermediate that, which is the goal of DeFi, is disintermediation. If you can disintermediate that and let the market makers come directly onto DeFi with no exchange sitting in between, then all of a sudden you have the liquidity and the pricing of exchange like Binance, but in DeFi, which is potentially the largest marketplace in the world. That's the vision of what Hashflow is trying to build.
So I'm not sure if this would be a Haseeb or Varun answer. You guys can hands up on that one. But so if we have new institutional players coming in and looking at what bloXroute is doing, and by extension, what Hashflow is doing, what is it that they are looking for or should be looking at? What is of interest to them, and how can they take what you're doing and take it to their boards or whoever the decision makers and go, this is something we should be looking at? What is it? What is the value proposition for them?
That's a great question. So here's what I'd say, and I'm sure Varun and Uri might have their own answers to this, but what I would say is that what these guys are doing is they are pushing forward the market structure of DeFi. Right now, if you look at DeFi in a vacuum, right, like what most people are doing today on DeFi is they're going to uniswap.com and they're typing in, I want this much of this and this much of that. And they're not thinking too much about the fees they're paying. They're thinking too much about the MEV that is being extracted. They're not thinking too much about, am I being front run? Am I being back run? Are people, am I fundamentally playing in a fair market? And the reality is that crypto is really new. DeFi is really new. There's a lot of stuff that we need to figure out in order for this stuff to scale and become, to the word that you said earlier, to become institutional, become ready for institutional players to really play on this stuff. And essentially what I would argue bloXroute and Hashflow are doing is they're basically civilizing the market infrastructure of DeFi to make it so that it works the way you might think that it ought to work, right? If I explain to you, if you come to DeFi, you're being told DeFi is the future of finance and it's super great, it's disintermediated, and I explain to you, oh, okay, great. Well, the way that it works is that, you pay super high fees, then you get front run by random people on the internet. And that's how DeFi works today. You'd be like, what? How is that? How is this better than anything? And the answer is like, look, it's early, and we have guys who are working on fixing this and making it so that the market infrastructure you're going to see, 2-3 years from now in DeFi, things like bloXroute and Hashflow are going to be so boring and staid parts of the infrastructure that you won't even talk about them. They'll just be there, and we all kind of know they're there, but they'll be like, okay, great, now we're on to the next thing, right? Now the market structure actually makes sense, and we don't need to keep talking about MEV. We don't need to keep talking about, the slippage and the front running on Uniswap. All that stuff becomes just, of course, like obviously the market infrastructure works the same way in DeFi as it works anywhere else. That's what these guys are fundamentally doing. And the hope is that 2 or 3 years from now, we won't need to have panels like this because it's all super obvious and everyone's using it. But right now, we're still in that transitional phase where the infrastructure for DeFi is being figured out. And that's what these two gentlemen are working on.
So I actually want to,
yeah.
I want to actually jump in and extend what Haseeb was saying. And I do agree with him. I think the really exciting thing about DeFi is, and this is especially true if you're coming from centralized finance, DeFi is on 24 hours, 365. It's not closed on the holidays or the weekends. It's always on. Everybody can participate. Everybody can be online. The same way everybody can go online. Everybody can open a shop and open a website. Everybody can be part of DeFi. This becomes like a single global world financial infrastructure that everybody are using. It's not fragmented into the US and Europe and Asia. It's one big thing. This is why so many people are so excited about it. But Haseeb is actually right. Like the way it's currently working is not dissimilar. You went online roughly 20 years ago, and your modem would do like these funny noises, and you'll wait for like 30 seconds for that to finish. And then you go and you open and you have like a picture, and it slowly kind of like loads from the top. Like, yes, it wasn't that great to begin with, but I couldn't imagine not using Netflix and Amazon and everything that we're doing right now. It's kind of like, of course, this is the infrastructure that we're using without even thinking. So I do agree with Haseeb, like we're building something that everybody in it, we're so excited about because it's going to be so big. It's already becoming pretty big, right? $1 trillion per year is no small number, but really this like wow, a single infrastructure which everybody can get on top on and use regardless of borders, etc. That this is something very, very exciting. And yes, Varun here and I are really trying to build something that's like, oh, here is the stuff that you need to actually take it from, 90s grade into, 2020 grade.
Exactly. And in fact, so Varun, I'm going to be throwing to you in a second because I actually have a question from our viewers, and I'd like to take this chance to say if anyone has any questions, we're going to try to get to a few, so please type them in on the in the chat there, and we'll see what we can get to. But the first one I've got is for you, Varun, and it actually comes back to the point that Uri was just saying. So the question here is, how soon do you think that there will be a complete transition from centralized funding to decentralized funding?
Decent, like a fundraising, like investments.
Well, I think I'm actually thinking it might have more to do with funding accounts, perhaps, or maybe he just means finance in general. But that was the question. So
it's maybe treated as finance. That feels like a better version of the question.
What's that?
Yeah, let's maybe treat the question as from CeFi to DeFi. I think
probably a CeFi to DeFi question. But yeah.
So generally, I don't think it's binary, where I don't see a world where everything would be decentralized. I also can't imagine a world where everything would be run by monopolies, right? So I think it comes down to where's the sweet spot, where's the intersection between the two that makes it work really well. And I think my general thesis around this is that centralization is a feature if it's by choice, but it's a bug if it's through force, right? So if you only had one choice and someone with a gun was forcing you to do that, then you had no other choice but to use it, right? So which means that's where having a decentralized system where you're not forced to comply to a system becomes more of a feature, right, to have. At the moment, you are giving the users the choice to do something that then not quite so, which is kind of the reason why decentralization of money is an interesting concept, right? Because before Bitcoin, you could say money was essentially, if you think of money as a technology, then someone with monopoly on the power of the gun had the ability to force its usage upon you, right? So you can almost think of as a highly optimized rent-seeking mechanism, which is fiat, right? So the moment you moved into cryptocurrencies, you essentially turn money into a network service that anybody can offer, and you had the choice to opt into a system that resonates more with you, right? So it's basically the framework I like to think about is being born into a system versus having the choice to opt into something. So in that sense, once you start building applications on crypto, you can almost think of them as setting up corporations within a nation state, right? So where your nation state is a L1 blockchain, and then all the apps being built on that are like in corporations that you're setting up in your Delaware. But in crypto, you're essentially building them on top of Ethereum, right? So or some other blockchain. So from that point of view, now someone running that service in order to improve user experience is probably a good thing, because the odds of that person being malicious are little, right? So in that degree, some centralization there is actually a good thing, right? So long as people have the choice to whether to interact with that application or not. And we kind of use the same kind of framework and applied it at price discovery level as well, right? Because we said, okay, the price discovery could be concentrated among some centralized players who already know how to do price discovery, so long as people have the choice to not take that quote if they don't want to. On the other hand, when it comes to trading, that's where, like, let's keep that UX decentralized in the sense that you don't have to trust anyone with custody of your funds. You can broadcast the trades, and you get to stay anonymous, and you get to be the anon that you ever wanted to be, right? So that's kind of how I see the space evolving, right? It's going to be an intersection of centralization and decentralization. Where that spectrum would lie is TBD, but I think that's kind of how I see it.
What are some of the stumbling? Oh, sorry, go ahead. Yeah.
I actually, I agree with Varun to some extent. I disagree with the other. So I do agree that it's not like, okay, when are we moving from centralized to decentralized? No, decentralized opens another door. Like you can do it in all sorts of ways. You don't have to, let's say, have your money in a saving or a checking account with predetermined percentile that you're getting on these, etc. Instead, you can have your money in whichever form you'd like. You can have it like vesting one way or investing in another, or pegged to some sort of basket or the other. So I definitely see, but the two coexist. I also expect people to still have bank accounts. I don't expect everybody to move. So I do agree with Varun on the fact that like we're going to have both. But I don't feel that DeFi is the wild west. We're kind of like, okay, I don't no longer need like a Delaware corporate or whatnot. On L1, nobody knows who I am because I'm anonymous on Twitter and whatnot. Like that's also a thing, but it's not the main thing from my perspective. So it's kind of like, yes, I'm like, if I'm thinking about us as a company, right? We're a big company. I don't know if we're big, but we're getting bigger and we're doing these kind of things and we need services. Some of these services we're getting very, very well from centralized finance, while others, we're doing a funding round. You know how long it takes to get funding, etc. Like it's a headache. Then we need to figure whether the funding arrived or didn't, etc. Well, if we use DeFi, it's kind of like, oh, give me your address. Oh, send me, done. Like within like 3 minutes, you finish the funding. And this is like, this is better. This is valuable. Like USDC is more valuable to me than US dollars because I can move it around faster and not with so much less headache. So I do agree that they should coexist, but I don't agree with the wild west general attitude of kind of like, we're outside of the center. No, you're in both, but you can choose where you want to be, especially if I'm thinking about us as a corporation.
Well, the next question that I got from the audience is actually one that I had been pretty much formulating in my head while you were speaking, because it actually goes to that idea of what are we waiting for? What do we need to do in order to get to that next point? If you had to pick one risk that needs to be solved for in order to get wider adoption on DeFi, what would that be? And how have you convinced some of the institutional investors you're working with to get there?
So I can speak in the context of Hashflow or what we've seen from our customers, right? So in general, I think market making is quite consolidated in crypto among the 5 to 6 players who are really driving the pricing across most platforms, both across CeFi and DeFi, right? So and now that we've basically got they're all plugged into Hashflow, which is great. I think most institutional traders or desks who want to route trades through us care about who the counterparty is, especially if they're very compliant. So giving them access to giving them the ability to basically KYC these players and then be able to swap, knowing who the counterparty is, so they know that they're not like, for example, sending money to OFAC countries or something like that, right? So that gives them a lot more ease of peace of mind when they go and trade across these platforms. So I would say that's like one of the biggest reasons what many of these institutionals are worried about when it comes to doing a full deep dive. I would say compliance is like a big thing, and if you can build a platform that can be customized to cater to the audience without being 100% compliant product, or at the same time 100% wild west product, I think that's the way to go.
As someone who, Haseeb, as someone who's actually looked at this from an investment side, what are you seeing as sort of the future of this sort of transition?
That's a good question. I mean, we've seen a lot of excitement in the last maybe like 3-4 months about this notion of regulated DeFi. Naturally, anytime that I hear like regulated X, usually it ends up being a total dog and not actually working. So if you look at Aave Arc, for example, so Aave recently launched a version of Aave that's kind of cordoned off from the rest of the Aave lending pools. I think it's now called Aave Pro, whatever, one of the two. And everybody in this pool is KYC. So only KYC actors can actually borrow and lend in this segregated pool. And unsurprisingly, it has basically no adoption, right? So the actors who are in there, They don't want to borrow and lend from each other. And I think part of the reason why these sort of regulated versions of DeFi haven't worked is that they kind of boil down to a, call it a sort of magical thinking about what DeFi actually is and what it can do. So a lot of the reason why people want to borrow and lend in DeFi, just take lending, which is obviously disconnected from what these guys are working on. A lot of the reason why the yields in something like Aave or Compound are so high is because of the fact that it's it's in DeFi and there's all this other stuff going on and it's very exciting. People are like, wow, I really want to get on DeFi so I can borrow at these or so I can lend at these amazing yields. Right, I'm getting negative real rates in the normal world. Why don't I come on DeFi and get these awesome yields? But I can't because my compliance department doesn't allow me to touch any of this stuff. So I'll go on this regulated version of DeFi, and there I'll be able to get these amazing use yields. The problem is that all the people who show up to the regulated DeFi platforms are all people who are used to paying rock bottom yields in normal finance, right? So you get a lot of people who show up to the same party saying, great, I also want super high yields, and I don't want to pay almost anything when I borrow. And it's like, oh, wait, yeah, obviously that doesn't work, right? The people who are borrowing at those high yields are not there in the KYC, super compliant, regulated pools because there's nothing magical about DeFi that makes yields high. The thing about DeFi that makes it so interesting is the fact that it's open, the fact that it's composable, and the fact that anybody can interact with it, right? Including smart contracts, including DAOs, including eventually even machines that may be able to participate in DeFi alongside human beings. And this broad concept of what DeFi makes possible is something that becomes incredibly narrowly constrained if your vision of what DeFi is, oh, it's like a better way for people to get high yields or to get, be able to trade tokens really fast with each other. So much of what makes DeFi powerful is the openness. And when you try to create a regulated version of DeFi, it's analogous, not exactly analogous, but similar to people who are like, oh, I want a regulated version of a proof of work blockchain. It's like, okay, I can understand why you might think that would be magical and valuable because Bitcoin's valuable and blah, blah, blah. But of course, slowly we've learned the lesson almost always that the regulated version of this crypto native thing, it somehow loses that spark inside of it, which is the thing that made it really special. And that seems to be, at least so far, what we've seen in DeFi. Now, I don't want to claim that there's nothing that lies there that's important and worth capturing, especially when it comes to figuring out identity, figuring out ways to, there are a lot of things that are gated behind identity in DeFi, like, unsecured borrowing, which right now all the borrowing and lending in DeFi is fully secured. And obviously that doesn't describe most of consumer lending. There are other things that I think will be enabled by full identity and being able to KYC people on chain. But the idea that, oh, okay, I'm only going to trade with people, only going to interact with people who are KYC'd, and that's going to be this like even better version of DeFi that's regulated, I think that's an unlikely vision for where DeFi is going to be compelling. Christy,
And
you're
that
muted
pretty
again.
much sums
There you
us
go.
up here. We have now hit our top of the hour, and that was a great way to end it because we're looking forward, but also understanding where we've come from in this whole DeFi evolution. So I just want to say thank you to everybody for participating in.
Oh, Christy, you just muted again.
You got muted again.
That was weird. Technology. Yeah, so thank you to everyone who tuned in. Thanks to Uri, to Hasib, to Varun, to bloXroute, and to Hashflow and Dragonfly Capital. And we really appreciate it. Hopefully people took away some interesting information and they can check you guys out online.
Thank you, everyone.
Thanks so much, everybody.
Thank you.